and welcome to EisnerAmper's Private Equity Dealbook podcast series. I'm your host, Elana Margulies-Snyderman, and with me today is Eric Byunn, co-founder, and Matt Alfieri, partner of Centana Growth Partners, a growth equity fund that invests in the future of finance. Today, Eric and Matt will discuss the transaction Centana completed with Beacon Platform. They will walk us through the process, along with both the opportunities and challenges faced when it came to the transaction. Further, they will discuss how they navigated through the due diligence process on the deal. Finally, they will share what Centana is looking for in the buy-side process to better ensure that both a mutually beneficial and efficient transaction can be consummated in today's economic and transaction market environment. Before we dive into the conversation with Eric and Matt, don't forget to hit that like button and subscribe to EisnerAmper wherever you listen to your podcasts. And you can also find us on YouTube at EisnerAmper. Hi, Eric and Matt. Thank you so much for being with me today.
Alana, we're happy to be here. Thanks for having us.
Absolutely. So to kick off the conversation, tell us about Centana and how you both got to where you are today.
Absolutely. Centana Growth Partners is a growth equity firm. We have about $1.25 billion under management, and we're just under about 11 years old. As you said in that very kind intro, we are solely and exclusively focused on investing in innovation in and around financial services. And as evidenced by the growth equity name, we are focused on investing at the growth stage, which is typically around $5 to $40 million in top line at the time that we invest. My personal background, I've been an investor for over 2 decades. If you go way back in my background, I led product management teams in Fintech and elsewhere. And then I was a partner in a firm that was initially called Financial Technology Ventures, became FTV Capital. And then we formed Centana again 10.5 years ago to stay focused on this stage of growth investing.
Hi, Elana. Matt Alfieri here. As you mentioned, I'm one of the partners at Centana. Thank you very much for having us. My background, I started in investment banking at Goldman Sachs in 2007. I did about 10 years there across investment banking and then moved into their principal investing team, where I was investing in Fintech and related software companies. And in 2017, I came over to Centana just after the firm closed Fund 1.
Great. So that segues nicely into the question I have for you. The investment in Beacon Platform is quite exciting, and I would love to hear the story from start to finish on your process of how you completed the transaction.
So for background, Beacon has a set of technology that helps developers at financial institutions develop applications and trading and risk management frameworks much more quickly than they would do ordinarily. Outside of Beacon or before Beacon, oftentimes you would have developers building spreadsheet-related applications or trying to leverage third-party trading risk management applications that were really hard to modernize. And capital markets firms really felt it hard to keep up with kind of changing times. So that's a bit of the background on Beacon. Just in terms of the sourcing story, so we are thematic in our approach to investing. We're constantly thinking about how the world around financial institutions will evolve and what sets of technology will help them do that. And so in our conversations with banks and insurance companies, we started to hear about some of the challenges around building applications in this space. And it set off a theme around low-code, no-code software. And so we started to look at a bunch of different companies in the space, but every time we would kind of test the idea with a given partner in our financial institution network, we'd often hear some of the challenges about low code, no code, not really being built for the markets today, not able to kind of withstand the security needs of large financial institutions, challenges with auditing what code was being built by who, and then finally, not being able to withstand large throughput of data. And so we kept looking, and then eventually we had a conversation with one of our advisory board members, who at the time was the CTO of Barclays. And John Stecker is his name. He's now the CTO of Blackstone. But when I was speaking with him at the time, he had put me onto a company called Beacon Platform. And his view was this company really helped solve that need. So we outbounded and got in front of the management team, and we started to learn about their plans to raise capital later that year. It's really important in our business where we are typically building proprietary relationships with management teams. And so we really focused on how can we help the founders, Kirat Singh and Mark Higgins, with their company before we were ready to invest. And where we saw the opportunity was, these were first-time founders. They've been executives at large financial institutions previously, but they've never built a company and they've never raised institutional capital. And so we really positioned ourselves as advisors to both Kirat and Mark. Here's the story that we think will resonate with investors. Here's the set of metrics that we think you should really work on developing and putting out in the market. And through that relationship and trust that we built over the course of 9 months, when they came out to raise capital in August of 2019, we were one of the first calls that they made. So that's a bit about kind of the relationship. And then just from a thesis perspective, as mentioned, what they were doing was really different than a lot of the low-code, no-code software out there. So we felt it was purpose-built for the problem that we saw in the market. And a key part of our thesis was actually the management team. Kirat and Mark had worked together for nearly 2 decades at a number of large financial institutions. They started their career at Goldman Sachs in the early 90s. There, they helped extend a similar type of software platform. Then they went on to work at JP Morgan, and there they built something called Athena. And then finally, in 2014, they got together to build Beacon together. And so this team had kind of been there, done it for large financial institutions, and now they wanted to kind of democratize that or bring that solution to the masses.
Just to complete on the question, after we spent the better part of a year sort of building a relationship with those founders, the actual investment process was very straightforward. We submitted a term sheet to lead the financing because, as you know, all good companies have choices, and they elected to work with us. We went through legal and confirmatory diligence, we'll talk about that in a second, but is a key element, making sure everyone's aligned and has a common view of how the company's going to proceed in pursuing our joint goals. And so we can all work together. And then we completed that initial investment.
Yeah. And just the last thing I'll say about the company is in our ownership, they did really well. We were invested for a total of 5 years. In the time that we were invested, they grew their revenue by 5x over 5 years. And ultimately, they were acquired by Clearwater Analytics in April of this year.
Great. And as a follow-up, Eric and Matt, what were some of the greatest opportunities you saw when it came to that transaction?
Sure. So we thought that they had really strong product market fit. And so we saw a real opportunity to help expand further, both in terms of geography, pushing further into Europe, but also pushing further into adjacent financial institutions like the insurers out there. Second, what they were initially selling was very much a platform, which is great because customers can build just about anything with it. But from a go-to-market perspective, that's hard to sell a platform at scale. And so we saw an opportunity to build more pain point specific applications to help enable a quicker sales cycle. And Eric, I don't know if there's anything you want to add there.
Yeah, I think, Matt, you mentioned it earlier, talking about Kirat and Mark and the entire founding team. This is a thesis that we repeatedly like when a team has been somewhere in the industry, in this case, a number of large Wall Street banks that Matt mentioned, and have an opportunity to see a problem and solve a problem from within that context. And then split out where they're very knowledgeable about what the issues are, how to solve it best since they've seen it sort of from the inside, and then build a company around making that exact same solution available to a much broader range of companies, funds, participants in the overall financial services kind of industry and ecosystem. So it was really an opportunity to work with these folks who had such technical brilliance, deep understanding of the use case. And then as Matt mentioned, they hadn't built a company like this before. So we were able to work with them on a number of the things around building a company and scaling a company that's selling into financial services.
On the other hand, Matt and Eric, what are some of the greatest challenges you faced when it came to the transaction?
Yeah, so the financing history of this company was sort of interesting because prior to us, the company had raised a round of financing from a strategic, from PIMCO. PIMCO was a great partner to this company, was a great partner as the company progressed. But when they had invested in a very early stage company in Mark and Karat, they had put in place a series of rights that made sense at that time and made sense for them as a strategic, but honestly made less sense as Beacon continued as an independent company and attracted investment from more classic financial sponsors such as ourselves. So we had an opportunity to work closely with PIMCO and find a path, frankly, a compromise, where they could keep some of the rights that they cared most deeply about, but where we were able to move those rights and that governance to something that was much more market standard for this type of a growth company.
Yeah, just one other challenge I'll add. We're no stranger to long sales cycles. The vast majority of companies that we invest in sell into financial institutions, and these are typically 6, 9, 12, even 18 months long. I would say Beacon was at the extreme end of that. They're really building mission critical software that risk teams, compliance teams, operations are all relying heavily upon. And so it can take a long time to actually get that software through the door. And so that was certainly one of the challenges that we had to kind of work through in our diligence.
Speaking of due diligence, I would love for you to touch upon the due diligence process when it came to the transaction.
Sure. So before the term sheet, we do all of our work. We want to make sure this is a team that we can invest behind. We want to make sure that the market is appropriately sized, that the product works as described, et cetera. This is all to say, 90% of our homework is done once we issue the term sheet. We want to make sure that we can stand behind it. Then we head into confirmatory diligence. And 10% of confirmatory is really ensuring that there is no, landmines, so to speak. There's not fraud or some misappropriation of information. Instead, what we're really focused on, the other 90% of confirmatory, is working with the company to put together a value creation plan. So the Centana deal team that leads the investment, along with our advisors, will go in and do a deep review of the accounting, systems, policies, financial practices, the engineering, the whole team, the code, making sure that it's robust, scalable, and secure, and the management team. And so we kind of package all this up into a series of recommendations, which we will bring to the management team before we close the investment. Because as minority equity investors, we're very, conscious of the fact that we don't control the business, but we do look to influence the outcome. And we try to do that through a data-driven approach. And so we'll sit down with the team, share what we found throughout diligence and our recommendations, and try to forge that alignment as we head into that 5, 7+ year relationship.
Eric and Matt, what are you looking for in the buy-side process to better ensure that a mutually beneficial and efficient transaction can be consummated in today's economic and transaction market environment?
So I'll just kick off and say, I appreciate there's a lot of news out there regarding the rhetoric around it's a dangerous time or a difficult time to raise capital. And we think this is a really good time to be investing and for companies to go out there and secure funding.
And so within that, we do what we have done in every part of the cycle. I mean, the most important thing is just to establish bilateral trust between us as a new party, as a new investor coming in, and all the stakeholders of the company, whether that's management, existing investors, even kind of customers and partners of that company. This involves just a real transparency and openness. One of the things that we do when we're negotiating terms is we will do the math, if you will, and lay out kind of what the effects at different outcomes and different paths are on all the constituencies. So being very transparent and open, we think is important. While sometimes it moves quickly, we certainly prefer when we've had the chance to build a long relationship, as we did in the case of Beacon. And of course, we can't emphasize enough how much it's important to do reference checks on both sides. CEOs and founders should always be calling references on us and any firm they're thinking about working with. As Matt said, it's typically 5 to 7 years, and you want to know who you're working with. And of course, we do extensive reference checking as part of our process. All of this just kind of leads to trying to guarantee that when we start working together as shareholders with all the different legal documents, you're sort of bound together. But it's just really important that there's a high degree of alignment again, between all the stakeholders, make sure that you all have similar expectations, understand where we're going to work together on improving either execution or occasionally elements of strategy, and just look for that alignment from day one after the investment closes.
Eric and Matt, we've covered a lot of ground today and wanted to see if you both have any final thoughts you'd like to share with us.
Yeah, look, first, very much like Beacon, we here at Centana are looking to invest in the future of finance. We're focused on companies that are solving real problems within that space, and they're doing something really innovative. And so that's helping them grow and move quickly. We are looking for companies in this growth stage, as we talked about earlier, 5 to 40 million in size, and we can be flexible and creative in figuring out how to work with the best companies. That includes thinking about the entrepreneur or the stakeholders' various needs and desires. It includes a broad range of investment structures that we will work with. One of the things we think about is making sure that the investment is sized appropriately for the company and for the stage of company. And that includes both making sure it's not too small, but also making sure it's not too large, and that too much capital is going into the company. And we're very happy working, whether we're the first-time institutional investor or whether we join a pre-established, existing, strong syndicate of investors already working with a particular company.
Well, Eric and Matt, I want to thank you both so much for sharing your perspective with our listeners.
Thanks so much for having us. We've really enjoyed it.
And thank you for listening to the EisnerAmper podcast series. Visit EisnerAmper.com for more information on this and a host of other topics. And join us for our next EisnerAmper podcast when we get down to business.